10 Criteria for Value Investing the Buffett Way. This video highlights what successful value investors, such as Warren Buffett, consider when investing in a business. These figures can be easily obtained from any free financial website such as Yahoo Finance or ADVFN. 1. Price-to-earnings ratio, below 20. Price to earnings is calculated as the share price divided by the earnings per share. For example, a share price of 10 pence and an earnings of 2 pence would give a price to earnings of 5, meaning it would take only 5 years for those earnings to cumulatively match the share price. 2. Price to sales ratio, below 1.5. This is a simple ratio for valuing a company and measures the value placed on sales by the market. It's particularly useful when comparing firms in the same industry. 3. Price to book value, below 1.5. Sometimes referred to as the market to book value, it's the price divided by the book value and can offer a margin of safety if it meets our criteria. 4. Debt to equity ratio, below 0.50. This shows us the financial health of the company, and a lower ratio is generally better. Note that financial institutions generally require more borrowing compared to other industries. 5. Dividend cover, above 2.0, can indicate the health and sustainability of dividend payments. 6. Dividend yield, above 4%. This target yield depends on the financial climate at the time. Investors should draw comparisons with savings and bond rates to gauge the attractiveness of the return. 7. Current ratio, above 1.5. This liquidity ratio measures a company's ability to meet short and long-term financial obligations. 8. Price to earnings times price to book value, below 22.5. Price to earnings times price to book value is called the Graham number and can be used as a screening tool in the search for undervalued stocks. 9. Return on equity, above 7%. A steady or increasing ROE gives us confidence that the business knows how to invest their earnings. 10. A steady or increasing dividend payment year on year highlights business stability and can increase the likelihood that investors will receive their dividends. Reinvested dividends will compound over time, increasing future dividend returns. That concludes our 10 criteria for value investing. Please follow the links in the description if you'd like to read more on the subject of value investing, and subscribe if you like the channel.